Treasuries are up again on the day in price, down in yield, but quite a bit of volatility intraday as yields started inching higher following the employment report this morning, which was, we need to remind people, I think, Cooper, Howard, pretty good report, right?
You know, it was a pretty good report, but I really think that it's a report that takes a big backseat. Maybe even if you're in a third row car, it probably goes in the third row backseat today. So I think everything's very much focused on tariffs, very much focused on how much in terms of this is going to be inflationary, how much in terms of is it going to be a growth hit. So yes, we did see a little bit better of a number, but again, it takes a backseat to everything else that's going on because it is backwards looking. So although the unemployment rate ticked up a little bit, we did add more jobs than originally expected, but it is backwards focused, and really where the market's looking at going forward, Oliver, is what's going to happen going forward.
Is, though, employment, a little bit more predictable? And so if the Fed's got two mandates, employment being right now looking pretty stable and predictable, and inflation related to tariffs being quite unpredictable, why wouldn't I more focus on the predictable and making my kind of decision-making process if I'm Powell?
You know, I think that that's a really good question. And that was actually kind of one of the questions that Powell was asked today. And it was, yes, you do have this dual mandate of employment and inflation. And if both aren't going in the right direction, then which one do you try to focus on? And his answer was that you focus on which ones are whatever's the furthest away from the median or furthest away from where your goal is. So I think that that's really what they're going to be looking at going forward. In terms of Chairman Powell and other Fed officials, it's likely that they're going to take a cautious approach from here, Oliver. I think they want to see where all the chips fall, where everything kind of comes out to where everything comes to fruition, and then begin to decide what to do with interest rates from there. I think one of the things that the market's really trying to grapple with right now is, are these tariffs going to be put in place long term, or is it a negotiating tactic? And that's going to be something that's pulled off very quickly and very shortly. The difficulty is, if you're a CEO or if you're a business, is how do you navigate through this? Do you plan on them being short term? Do you kind of sit to the sidelines, wait for things to adjust? Or do you plan longer term and maybe shift around your supply chains? So I think that that's really where a lot of the volatility could continue going forward.
Okay, and where then do we hide if we don't want that volatility, Cooper?
You know, I think the thing is, there are still opportunities within fixed income. You did say that we saw a big move down in yields. That is true, but if you look at longer term, yields are still relatively attractive. One area that I'd highlight, Oliver, though, is the muni market. Right now, if you look at munis yields relative to treasuries, they're at near the highest over the past 2.5 years. If you also look at them relative to corporates, you really only need a 22% tax bracket or above for the average municipal bond to yield more than the average corporate bond. That again is the most attractive in the past 2 years. If you also look at credit quality, tends to be that many municipalities, they have revenues that are a little bit isolated from a lot of the issues that are going on with the trade war. So that, I think, is an area of opportunity if you are in a higher tax bracket.
Okay. I had a guest, Cooper, I think yesterday, was talking about the merits of commercial mortgage-backed securities. And when I asked him about munis, he said, fine, munis fine, but I think there's total quality high enough in that market to get extra juice there. What do you think about that?
You know, I don't necessarily think that that's too much. I think if you were to look at munis and say they're fine, I think munis are actually pretty good opportunities, similar to kind of some of the points that I'd highlighted before. So I think that's really where more of the opportunity is than the MBS market.
Do you go for riskier stuff? Where's the best pull on income in munis right now?
I think if you're looking at the market, you kind of look at an average duration. Right now, the average duration of the benchmark is about 6 years. So I would stick to intermediate term. If you're a little bit riskier, there is a case that could be made about adding some longer term bonds.
I was thinking issuer, like geographic.
Geographic, I think one of the big things that factors into that is what state are you invested in? So we know that if you invest in a municipality issued by your home state, it's often exempt from state income taxes. So I wouldn't necessarily look at individual issuers of geographic, I'd really look at what is backing those specific revenue sources. Areas to where I'd be a little bit more cautious, though, would be like higher education, healthcare issuers. I think that there's some fiscal policies that could be coming down the pipeline that would be a headwind to those types of issuers.
Okay. Cooper, thanks a lot. Enjoyed talking bonds with you.
Thanks,
Love a
Oliver.
muni
Really
mind.
appreciate it.
Appreciate that. Absolutely.